My dear friends, welcome back. Today I want to talk to you about something deeper than charts, deeper than valuation, and deeper even than the idea of intrinsic value itself. I want to talk to you about the lie investors tell themselves right before they lose money. I saw this lie in my own era, and I see it even more clearly in yours, unchanged, unchallenged, and incredibly destructive. Let me begin with a simple truth. Before every major loss, the investor's mind whispers, "I'm different. I won't be the one who's wrong." This, my friends, is the big lie. Not a lie told by the market, not a lie told by companies, but a lie told silently inside the investor's own mind. It is the most dangerous form of emotional bias, and unless you learn to see it clearly, you will fall into the same behavioral trap that has misled investors for over a century. Now let me take you back for a moment. In my time, people believed that railroads could only go up. They believed steel mills would dominate forever. They believed certain industries were too important to fail. The story was always different, but the psychology was always the same. When excitement rises, the mind seeks comfort, not truth, and comfort creates blindness. In your era, this same lie has taken on a new form. It hides beneath glowing screens, viral opinions, and the explosive optimism that surrounds modern technology. You are told that software is limitless, that innovation never slows, that disruption guarantees profit. And as prices rise, the lie becomes louder. This company can't crash. This time is different. But nothing about investor psychology is different. Let me illustrate this with a case I recently studied. A modern technology company that soared higher and faster than almost any business of its size should. I won't use its real name. It doesn't matter. What matters is how investors thought. The company created a remarkable product. Simple, elegant, widely adopted. Revenue exploded. Media celebrated it. Analysts praised it. Influencers called it the future. Everyone seemed certain the company would dominate the next decade. The stock rose from $40 to $300 in less than 2 years. And as the price climbed, something predictable happened. The big lie awakened. Investors stopped seeing risk. They stopped questioning. They stopped asking whether the price made sense. Instead, they repeated the same comforting phrase, "I can't be wrong. Look at the chart. Look at the hype. Look at the growth." But my dear friends, when investors stop asking questions, danger begins. This is where overconfidence, confirmation bias, and control illusion quietly take over. The investor no longer analyzes the business. He begins defending his belief. He ignores signs of slowing demand. He dismisses warnings about valuation. He follows the crowd because following the crowd feels safe. Emotionally, he believes he is in control. Rationally, he is drifting further from reality. And yet during this entire rise, the company's financial statements revealed something very different. A dependency on temporary conditions, increasing costs, slowing efficiency, and clients whose demand was starting to flatten. The story was strong, but the numbers were quietly weakening. This is the behavioral trap I want you to understand. When the story becomes more important than the facts, the loss becomes inevitable. Let me tell you the moment where everything began to turn, because it is here that the big lie becomes most visible. Investors stopped asking, "What is this company worth?" and replaced it with, "How high can it go?" This one shift from value to excitement is the precise point where rationality collapses. In the next part, I will show you exactly how this happens step by step, the emotional climb, the narrowing of judgment, the blindness to risk. And then we will analyze why the collapse was not a surprise at all, but the natural consequence of ignoring intrinsic value. For now, remember this. Before every loss, the investor lies to himself. Before every gain, he tells himself the truth. Let's go deeper. Now, my dear friends, let us take a closer look at how this modern technology company, this symbol of optimism, became a perfect stage for the big lie to unfold. Because the truth is this: markets do not collapse suddenly. Minds collapse first. Prices simply follow. At the peak of excitement, investors repeated the same lines with absolute conviction. Everyone is using it. Growth will continue forever. If it doubled before, it will double again. These statements were not analysis. They were emotional affirmations, comforting phrases designed to silence doubt. And the more the price rose, the more comforting the lie became. Let me show you what was really happening beneath the surface. As the company's stock climbed from 40 to 100, fundamentals were still strong. The business was growing quickly, acquiring new users, expanding into new markets. But when the stock surged from 100 to 200, the psychology shifted. Investors were no longer buying the business. They were buying the belief that other investors would keep buying. This is called the expectation loop, a powerful behavioral trap. Investors no longer study what is happening. They study what they want to happen. They look for confirmation. They filter out anything uncomfortable. They fall in love with the story. And stories, my friends, can be dangerous. As the price raced toward 300, the warning signs were already visible. Customer growth began slowing. Operating costs climbed sharply. Profit margins weakened, competitive pressure increased, and most importantly, valuation disconnected from reality. But investors did not see these signals, not because the signals were invisible, but because they were psychologically unavailable. This is what behavioral theorists now call selective perception. In simple terms, the mind sees only what it wants to see. In my era, I witnessed this many times. Investors would ignore the weakening railroads because they were attached to the glory of the past. In your era, investors ignore weakening tech fundamentals because they are attached to the glory of innovation. The cycles repeat because human nature repeats. Now, here is the part most investors never understand. The higher the price climbs above intrinsic value, the more fragile the confidence becomes. People believe rising prices reduce risk, but in truth, rising prices increase psychological vulnerability. When an asset becomes overpriced, even a tiny problem, a missed earnings report, a slowdown in growth, a shift in headlines, can shatter the illusion. And once the illusion breaks, the fall is rapid and unforgiving. That is exactly what happened in this modern tech case. The company released an update. Growth was slowing, customers were becoming more cautious, and expenses were rising. It was not a disaster, just a normal business cycle. But remember, investors were not responding to reality. They were responding to their belief in the story. The moment the story cracked, panic rushed in. The stock fell from 300 to 200 in a matter of weeks. But instead of accepting the truth, investors doubled down on the lie. It's just a dip. I will buy more. The market is wrong. This is where loss aversion and denial take over. When faced with information that contradicts their beliefs, most investors do not change their beliefs. They reinforce them. They protect their ego instead of their capital. And so the decline continued. 200 became 150, 150 became 90. Fear began replacing optimism. Investors felt betrayed, not by the company, but by their own expectations. Meanwhile, throughout this entire period, the company's intrinsic value remained far below its peak price. The fall was not a surprise. It was a return to reality. My dear friends, this is the true danger of the big lie. Not that it leads you to buy at the top, but that it prevents you from seeing the truth until it is too late. In the next section, I will explain how we could have recognized the turning point long before the collapse, and how a rational investor uses intrinsic value, not emotion, to stay grounded while others drift. Let's continue. Now, my dear friends, let us examine the most misunderstood moment in every market cycle, the turning point. The moment when optimism quietly transforms into denial and denial silently transforms into panic. Contrary to what people believe, markets do not collapse because of a single piece of bad news. They collapse because investors are emotionally unprepared for the truth. Let's return to our modern tech case. When the company released its slowing growth update, rational investors would have taken it as a simple signal. The business was normalizing, not dying, not collapsing, just normalizing. But investors who had embraced the big lie responded differently. Instead of asking, "What is the business worth?" they asked, "How can I protect my belief that it will keep rising?" This shift from objective analysis to emotional self-protection is the real beginning of every crash. At this stage, several predictable psychological forces emerge. 1. Confirmation bias intensifies investors' search for any evidence that supports their hope. They avoid reports and experts who challenge their view. They mute warnings. They follow voices that tell them what they want to hear. 2. The ego barrier rises. The investment becomes part of their identity. Selling feels like admitting failure. Holding feels like protecting pride. 3. Short-term anchoring takes over. Investors measure value based on the recent price peak rather than earnings, cash flows, or realistic expectations. They ask, "How do we get back to $300?" instead of, "What is a fair price?" 4. Loss aversion creates paralysis. As the price drops, fear grows. But instead of acting clearly, investors freeze, hoping for a rebound that rarely comes. All of this happened in our tech company case. The business was still good, but the story investors believed was crumbling. Now let me show you how I approached this situation using the same framework I used throughout my career. I asked a simple question: what would this company earn in a normal year? Not the peak year, not the promotional projections. A normal year, when I smoothed out revenues, removed extraordinary growth periods, and considered the cost structure, the company's earning power value became clear. It was not bad, but it certainly did not justify the valuations investors were paying at the top. Next, I reviewed the balance sheet. Cash was strong. Debt was moderate. Operations were stable. This confirmed something important. The company itself was not failing. Only investors' expectations were. This is the exact moment where intrinsic value becomes a lighthouse. While the emotional waves rise and fall, the lighthouse does not move. Let me highlight something essential. The gap between intrinsic value and market price is the psychological pressure zone. When price is far above intrinsic value, investors become fragile. When price falls below intrinsic value, investors become terrified. But the rational investor sees both situations for what they are, temporary distortions created by emotion. In our case study, when the stock fell from 300 to 150, the intrinsic value had not changed much. The collapse was simply the market correcting the excess optimism investors had built. But something even more telling happened next. Investors who had denied the truth at 200 suddenly became panicked at 100. This is the tragic irony of market psychology. People ignore danger when prices are high and exaggerate danger when prices are low. At this stage, the lie that once felt comforting becomes a heavy burden. Investors say, "I should have sold earlier. I knew it. I can't believe this happened." But the truth is simpler. They did not lose money because the company failed. They lost because their mindset failed before their analysis did. My dear friends, when I analyze these situations, whether they occurred in my time or yours, I see the same pattern every single time. The collapse begins not in the balance sheet, but in the investor's belief system. In the final part of this lesson, I will show you how to break this psychological pattern, how to recognize the big lie before it blinds you, and how to build a mindset that thrives in both excitement and fear. These principles will protect you today, and they will protect you in every future market cycle. Let us continue. My dear friends, now that we have seen how the big lie forms, grows, and finally collapses, let us turn to what truly matters, how to break this pattern forever. Because the greatest gift you can bring to your financial life is not prediction, nor intelligence, nor even opportunity. It is psychological clarity. Let me begin with a lesson I learned slowly in my own career. Most investment losses occur not because investors lack information, but because they refuse to face information that challenges their beliefs. And this refusal is what turns small mistakes into catastrophic ones. So how do we break the big lie? How do we build a mindset that remains calm through hype, grounded during mania, and steady during decline? Allow me to share with you the anti-lie framework, a simple but powerful set of principles I wish every investor carried with them, especially in the modern era. 1. The truth before the story. Before you listen to opinions, headlines, forecasts, or excitement, ask one grounding question. What are the facts? Return to revenues, margins, cash flows, balance sheet strength, and realistic earning power. If the story is louder than the numbers, you are already in danger. 2. The intrinsic value anchor. You must decide what the company is reasonably worth before your emotions get involved. Intrinsic value is not a perfect number. It is a stabilizing force. When the price rises far above it, do not celebrate. When the price falls far below it, do not panic. Let value, not excitement, be your reference point. 3. The emotional temperature check. Before every major financial mistake, the investor's emotional temperature rises. Excitement feels like certainty. Optimism feels like evidence. Confidence feels like control. Whenever you feel these signals, pause. Your mind is entering the zone where rationality begins to dissolve. 4. The what would break me? Question. Ask yourself, if I am wrong, how much damage can I tolerate? If the answer frightens you, reduce your position. A rational investor never builds a financial identity around a single stock or trend. Markets punish pride long before they punish bad businesses. 5. The 48-hour reality rule. When fear or greed suddenly rises, do not act immediately. Let your emotions cool for 2 nights. Truth becomes clearer when urgency fades. This single habit has saved more investors than any complex analysis ever could. Now let us return to our modern tech company one last time. The company itself did not vanish. It continued to operate, serve customers, and develop products. But investors who believed the big lie, who trusted their feelings instead of the fundamentals, suffered the emotional collapse long before the market corrected the price. This is the central insight I want to leave you with today. Investors do not fail when markets fall. They fail when their minds fall before the market does. Throughout my life, I observed this same pattern across generations, across industries, across economic eras. Whether it was railroads in my time, consumer giants in the 70s, internet companies in the early 2000s, or technology platforms in your own decade, the psychology never changes. And because psychology never changes, the disciplined investor will always have an advantage. My dear friends, the future will bring new innovations, new opportunities, and new stories that promise to reshape the world. Many of them will be true, but even the best stories cannot protect you from the consequences of ignoring value, overestimating certainty, or trusting your emotions more than the numbers. If you can remember this, truly remember it, you will be able to face every market cycle with calm confidence. You will avoid the big lie. You will survive the extremes of optimism and pessimism, and you will build wealth not through luck, but through clarity. Thank you for spending this time with me. In our next conversation, we will explore another cornerstone of intelligent investing, a principle that will further protect you from the errors that have harmed investors for more than a century. Until then, hold steady, think clearly, and always insist on your margin of safety.